Welcome back to my YouTube channel. So we'll continue the revision. And if you're watching this video for the first time, please take a minute to subscribe. Let us get to 1,000 subscribers in the next 30 days. Without much ado, let me read the question. So today I'll do question 23, which was tested in August 2024 sitting. So I'll read the question. Folico Manufacturing Limited produces a premium jewelry. The company prepares its budget for the year based on the estimated production and sales of its products. The following budget was prepared for product Malkia for the current month based on the production of 1,250 units. However, due to the unexpected demand, the company ended up producing 1,500 units. Below are the budgeted and actual figures. So we have budgeted figures 1,250. Then we have direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead, variable sales and administration expenses, fixed sales and administration expenses. So we have total manufacturing cost, which is the total of all this. Then actual for the 1,500 units, we have direct materials that 2,000, direct labor 25,000, variable manufacturing overhead 18,000, fixed manufacturing overhead 75,000, variable sales and administration expenses 20,000, fixed sales and administration expenses 65,000. So total manufacturing cost is 235,000. So additional information, number one, the selling price for product Malkia is shillings 230 per unit. Yeah. The number two, where necessary, use the per unit variable costs derived from the budgeted figures. Then three, Folico Manufacturing Limited has a sales contract to deliver 850 units of product Malkia every month. Number four, Folico Manufacturing Limited sells averages 80% of the units produced in any month. This percentage is inclusive of the sales contract units. It's inclusive of the 850 units. So it means that the sales units will be 80% of the units produced. Yeah. So number five, corporation tax rate is 30% payable on realized profit. Yeah, so I'll have to put it there. So required, prepare a flexible budget for 1,500 units. That's 4 marks. B, determine the total flexible budget costs for 1,500 units. That's 2 marks. C, at 1,500 units, compare the flexible budgeted cost with the total actual costs. Using a logical function, identify the variances as either adverse or favorable. Then part D, prepare an income statement for manufacturing levels of 1,000, 2,000, and 2,500 units of product Malkia. That was 8 marks. So I'll go straight away and do the question. Part one, we are required to prepare a flexible budget. So for us to prepare a flexible budget, we must have the original budget. Yeah, so I'll start with the original budget here. The original budget. So there is the original budget income statement. Yeah, it's the original budget income statement. So let me have the units. Yeah, I just put the units there. So the units budgeted for, the units produced under the original budget was 1,250. Then we have the sales, which is the sales revenue. Yeah, and for sales revenue, we go to additional information number 4. They are saying that Folico Manufacturing Limited sales averages 80% of the units produced in any month. So under the original budget, there was a budgeted production units of 1,250, but it's only 80% of this that is being sold, which generates revenue. So we just say equals to, you know that sales, which is revenue, is equal to price times quantity sold. Yeah, so it will be the price, which is, it was 230 per unit. So we'll have that 230. We multiply by the units produced, but out of that, only 80% was sold. Yeah, times 80%. Yeah, times 80%. So the sales will have 230. Yeah, that's 230,000. That was the sales revenue. Yeah, then now we go to the costs. Yeah, so I'll start with, I'll have to classify them into, I'll start with the variable costs, the cost that's vary. So I'll say, yeah, direct materials. Yes, the direct materials, the total production cost is what we have been given. Yeah, it doesn't change. So that's what we pick that. Then direct labor, we'll have this 25,000. Then variable manufacturing, yeah, that's a variable cost. Let me extend that. 12,500. Then we also have variable. Allow me to skip the fixed cost and pick variable sales. Sorry. Variable sales and administration. Yeah, you have to classify this cost accounting. Yeah, you have to classify costs. Yeah, so I'll take variable sales and administration, which is 18,000. So that I get the contribution. Yeah, the contribution under the original budget. The contribution will be the sales, the revenue minus the variable costs. Total variable costs. I'll sum all this. And I'll enter that. Then that will be my value. Then I'll have fixed cost now. So I'll take fixed manufacturing overhead. Less from the contribution. Fixed manufacturing overhead is that. Then we'll also have fixed sales and administration expenses. So these are fixed costs. So I'll also deduct that. So that we get the operating income or the profit before tax. Yeah, so let me just say profit before tax. So the profit before tax will be the contribution minus the sum of the fixed costs. So I'll subtract that to get that as the profit before tax. Is there anything I left out? 7 variable manufacturing overhead, 500 variable sales, 18,500. 500. Yeah, that's okay. That's okay. Fixed sales and administration, that's okay. So that the tax was 30%. So I'll just pick the tax rate here and lock it because I'll use it even when it comes to flexible and the actual. So allow me just to lock it completely. Yeah, then I'll create a negative sign because I'll want it to be negative times the profit before tax. Yeah, so my net profit now, or the profit after tax, the net profit will be the sum of these two. So under the original budget, that's what I have. And I was just using the original budget to be able to calculate the flexible budget, because what the examiner requested of you was to prepare a flexible budget for 1,500 units. So I'll extend this. Yeah, so the flexible budget now for me to get the units were 1,500. We are told at 1,500 units produced. Yeah, so what I love here, I love the flexing ratio or the flexing factor. And my flexing ratio will be equals to actual. Yeah, the actual, which we are using the flexible budget, we are using the actual units produced, the 1,500, you divide by the original budgeted. That's the flex ratio. The original the budgeted output. Yeah, so we'll have a flex ratio of 1.2. So when you are preparing the flexible budget, just take this 1.2 and multiply by all the items which can be flexed. Yeah, so it's only fixed cost that is going to remain the same on the flexible budget. So I'll start with the sales. So I'll pick this and I'll multiply by the flex factor. And because the flex factor is constant all the way, so I'll lock it completely. Yeah, I'll lock it completely. This helps in saving time. Yeah, you don't have to do everything individually. Then I'll also lock the column F. Yeah, then I'll enter. So I'll have 276,000 as the sales. Yeah, so I'll just drag this all the way up to variable sales and administration expenses. So up to this point, these are the only items that we can vary, so that the contribution, I'll just have to stretch that. Yeah, contribution now will be 177. Then the fixed manufacturing will remain the same. Yeah, this doesn't change because it's fixed cost. So you can't flex fixed costs. So fixed sales also will remain constant, so that the profit before tax, I'll just do that, will be 37,000. And the tax will be 11,100. Then the net profit, you just drag this. The net profit, you drag that. Yeah, so it will give me a net profit of 25,900. So this is the flexible budget. This is the flexible budget. This is what the examiner requested from you. So that will give you a total of 4 marks. Yeah, that will give you a total of 4 marks. Yeah, that will give you a total of 4 marks. Yeah, so that's how you are supposed to do part A of that question. So part B, determine the total flexible budgeted cost for 1,500 units. And this is only 2 marks. So you just come to this information, the total flexible budgeted cost. So budgeted cost will be, just come here, part B. Sorry. Part B, so the flexible budgeted cost, you just come to cost. Costs are everything from direct material all the way to fixed sales and administration. So you start with the direct materials. So you just come and say equals to, yeah, the value that we have here, 32,400. Then direct labor, value that we have is 30,000. Then variable manufacturing overhead, allow me to extend that. Variable manufacturing overhead, we have 15,000. Then fixed manufacturing overhead, it was how much? To 75,000. Then we have also fixed sales and administration expenses. We'll have 65,000. Yeah, so that the sum of all this will give us the total flexible budget for the 1,500 units. Yeah, total is the total flexible budgeted cost. Yeah, so total flexible budgeted costs. Yeah, so I just sum all this. You just sum up there. Yeah, so the total was 217,400, 217,400, 217,400. That is the total flexible budgeted cost. So allow me to bold that so that you can see it clearly. So that's what the examiner required of you in part B of that question. part B of that question. So we go to part C. They're saying at 1,500 units, compare the flexible budgeted cost with the total actual cost using a logical function. Identify the variances as either adverse or favorable. Yeah, so I'll just do it up here. So I'll compare. So let me do it down here. Let me do it somewhere here. So let me copy the flexible budget. So we'll compare. What we compare with the actual is the flexible budget. Yeah, because flexible budget has the same units as the actual. You can't compare the original with the actual. So the flex budget, I'll copy it all through. Control C. Then let me put it here. Flex original variance here. So let me copy it here, Control V. I don't know why it's not giving the values. It's okay. That. Sorry, let me just do it here. Yeah, I put the flex there, but there should have been actual. But let me just do it there. So actual. Actual budget, sorry. Yeah, actual budget. So the units still remain the same. So the units will be 1,500 the same way. The units will be 1,500. So therefore sales. Yeah, so if the units were 1,500, then sales will be 1,500 times 230. Yeah, so it will be 1,500 times the price per unit of 230. But you know, the revenue, we are only able to sell an average of 80%. So you take that 80% and you enter. So for sales revenue, it will be the same with the flex and the actual. Yeah, so for direct materials, for costs, we have the information provided for the 1,500 units. You just pick the informations the way they are. So direct material was 32,000. Direct labor, was 25,000. Then we have variable manufacturing overhead. Variable manufacturing overhead was 18. It was 18. Then variable sales and administration expenses was 20. So let me just say equals. Then we have 20. It was 20. Yeah, so from here, let me just calculate because now I can't drag. Let me see if I can just drag this. Yeah, so we'll have 181,000 as the contribution. Then the fixed manufacturing, the fixed according to the actual budget, the fixed manufacturing overhead was 75. Then the fixed sales and administration was how much? Was 65. Yeah. So up to that, now the profit before tax, we just drag that. It will give us 41,000. Then tax, that, then that also. Okay. Yeah, so we have the actual and flexible budget. So this is what we are going to compare. Exactly what the examiner is asking for is the variances. So at 1,500 units, compare the flexible and with the actual total cost. Yeah. So we are going to check at the variances under cost because you can see at sales, there was no variance at all. Yeah, because we had 276, 276. Then from cost, the only place that will have variance is this variable cost from direct material, direct labor, variable manufacturing overhead, variable sales and administration expenses. When you come to fixed manufacturing and fixed sales, they were 75, 75, 65, 65. So there was no variance at all. Yeah, so I'll create a column here for variance. Yeah, and this variance, we are going to use the logical function. Yeah, like now, let me start with the direct material. When you check at the flexible budget, we have budgeted for a material of 32,400, but we end up spending 32,000. Huh? Yeah, the actual was 32,000. So we budgeted for 32, but we spend less, which is 32,000. So we budgeted for 32,400, but we actually spent 32,000. So we spend less. Yeah, in cost, when we spend less, that's favorable. Yeah, that's favorable. When we spend less is favorable. So we'll use the if analysis. Yeah, we'll use a logical function. Here, you are not to say right here advanced, favorable. No, you have to prove through a logical function. So this is what I'm going to do. So I'll say equals to, then I'll go to where the functions are. Then I'll look at the category, I'll pick the logical, then if, I want to use if, then I just say okay. So the logical test is, let me move this. Let me move this one here. Yeah, so that you can see it clearly. Yeah, sorry for that. Yeah, so you have a logical test there. Sorry for that. So the logical test is, we say that under this actual budget, if it is less than flexible budget, then it means that it's a favorable. Yeah, so you say 32,000 less than. Less than 32,400. Yeah, it's favorable. So value if true, yeah, if it is true, then you say here it's favorable. Yeah, if this is less than this, then it's a favorable. Then what happens if it's not less than that? If the value is false, then it's adverse. Then you say adverse. Yeah, so if it is false, then you say adverse. So you just say okay. So once you say okay, you can see it will give me favorable there. Then you just pick, you just drag this all through up to variable sales and administration expense. So yeah, so you can see you'll just get the values as adverse or favorable without much problem. So when you come to the value which is giving us, let us see the favorable second one. We budgeted for 30,000, but we end up spending 25,000. So we use less. So in cost, when you use less, then it is favorable. Then what of this which is adverse? We budgeted for 15,000. But we end up spending 18,000. So you spend much. So that's an adverse variance. So that's how you are supposed to do this using a logical function. So that's how you are to calculate that part using the logical function. For these other ones, for these other values, then we were not supposed to, yeah, the fixed, they remain the same. So there was no variance. Yeah, there was no variance at all. Yeah, so that's how you are supposed to do that part and get your 6 marks. Yeah, you get your 6 marks. You just use the logical function. Yeah, so in this question, if you don't use the logical function, then you won't be right. Yeah, yes, you can analyze that is favorable, but you are told to use the logical function. So use the logical function if, yeah, to get the favorable or adverse or favorable. Okay, so we go to the last part of the question. And then they're saying, prepare an income statement for manufacturing levels of 1,000, 2,000, and 2,500 units of product Malkia. So we'll use the income statement. Yeah, so we'll say the income statements. Yeah, so we'll have units. Sorry, let me put it here, units. So the units will be, yeah, so we'll have different categories because we'll have at the levels where we produce 1,000. We'll have a level where we produce 2,000 units. We'll have a level where we'll produce 2,500 units. So the next thing here will be sales revenue. So let me just write sales. Yeah, but we know that the sales, we can only make 80%. Yeah, it's average 80% of the units produced. So if you produce 1,000, we can only sell 80. And that also know 80% that will generate the revenue. So this is what I will do. So I'll say equals. In fact, this is actual now. We'll use the actual values. Yeah. So you'll take 1,000 units times the selling price, which was 230 per unit. Then you multiply by the 80% because you can only generate revenue from the 80% and you enter. And because now this is constant, the selling price is constant and 80% is also constant. Yeah, so it will be easy if I lock, but let me see if I drag and see if it will give me the values. No, it won't. So I'll have to lock. Yeah, so no, I'll just do it. Let me just do it. Let me just pick 2,000 because 80% is not in a cell. So I want to be able to lock it. So I'll waste time. Times the selling price of 230 per unit times what do we have? Times the 80%. Yeah. You are only able to generate revenue from the 80%. Yeah, so we'll have 368. Yeah, then for this now, we'll also have 2,500 units times 230. Then you multiply by the 80%. Yeah, because it's averages 80%. Enter. So we'll have that as revenue. Yeah, then we now come to cost. So we'll have to start with I'll start with the variable costs. So I'll start with the direct material. Yeah, so I'll do the same thing I've done. Yeah, that's how I'll do the income statement. Yeah, so start with the direct materials, but this is now under actual. Yeah, so here we are going to look at the direct material cost per unit. Yeah, per unit here. So in this, we are given actual, there were 32 shillings was 32,000, but we had 1,500 units. So we'll get per unit. Then I'll also do the same with direct labor per unit. Then I'll do the same with variable manufacturing per unit. The fixed cost remain the same. Yeah, that will remain the same all through. Yeah, then variable sales, I'll pick that and divide by per unit by 1,500 to get the cost per unit. Yeah, then fixed sales will remain the same. Yeah, so I'll start with the direct material. So the unit, the direct material per unit was how much? It was 21. Huh? Yeah, so that 21 I'll multiply by 1,000. Yeah, but this one is constant because it will be all through. Yeah, so I'll lock it completely. I'll lock it completely. Yeah, then I enter. So once I enter that as a direct material, so I can drag it all through. Yeah, so this will give me the value for E43 times what I've locked. Yeah, so that's correct. Yeah, so we go to the next item, which is the direct labor. So the direct labor, we'll have labor cost per unit and actual. Yeah, so we'll have that times the number of units. So I'll also lock this completely so that I can just drag. I'll enter that, then drag it all through. And the next item will be variable manufacturing overhead. Yes, I'll pick the cost per unit, yeah, because these are variable costs. So 12 times the number of units produced and sold. So produce, so I'll lock that again. I'll lock that again, then I'll enter. Then you just drag. Those are the values will appear there automatically. Yeah, then I'll go to the next item, which is variable sales and administration. So I'll take the cost per unit, which is that, and I'll multiply by the number of units produced. So I'll lock this, and I'll also lock this other one. Then I'll enter. So once you do that, just drag and the other values will appear automatically. Then we now have the contribution. Contribution will be the sales revenue minus costs, the variable costs. Yeah, minus the variable, total variable costs. So I'll sum all that and enter. So that once I have that value, I'll just drag. Yeah, so let me bold that. Then I'll now look at the fixed costs so that I can get the operating income or the profit before tax. Yeah, so the fixed manufacturing overhead, this one remains the same regardless of the number of units produced. Yeah, so we'll have it at 75,000. It will be constant all through, so you'll copy it for all these items. Let's see, yeah. Then the same will happen to the fixed sales and administration. So for the fixed sales and administration, you do the same. Fixed sales and administration, it will be constant regardless of the number of units produced. Yeah, it doesn't vary. You don't vary it. Yeah, so it's constant all through. It's a fixed cost. So we'll get the operating income, or let me just say profit before tax. So the profit of before tax will be the contribution minus the sum of these two. Sorry. Sum of this so we'll have that. Sorry. We'll have this minus the sum of those two. Sum those two. Yeah. So we'll have a loss of 1933. Then you just drag. Yeah. So here we'll have a loss of 19,000 units, but here we'll have profit. Yeah. So you can say profit before tax. Then we have tax. So the tax rate will be charged to 30%. So it will be 30% times then times the profit before tax. So I'll lock this. I'll lock it. Yeah, because I'll use it all through. So I'll enter. Yeah, so you have a positive 58. But let me see. I don't know why the tax. Yes, there was no profit. It was a loss. Huh? So let me see. So you'll have the tax rate is 30%. Let me lock it. Sorry. Yeah, let me just multiply direct with the value. Okay, so you'll have that. Then, because I've locked it, I'll just drag that. Yeah, so that the profit after tax, or the net profit, in this case, the net profit will be this minus that. Yeah. So that we have 13.5. Yeah, that's correct. So that we drag that. Yeah, so that's the net profit for the items. Yeah. Yeah, so that's how you are supposed to do the income statement for this question. And yeah, so I'll just say a net profit or in bracket loss. Yeah, so that where we have negative, you know, it's a loss. Where we have profit before tax, profit or loss before tax. Yeah, that's how you're supposed to do it. Yeah, so this is how you are supposed to handle this question, and you get yourself 20 marks for this question. So thank you so much. Our intake for September classes is ongoing. So please check my number on the bio and contact me for business data analytics classes. And I can assure you, you will pass on your first attempt. Thank you so much and have a blessed evening.